I'm all good to go, mate. Looking forward to our chat.
Excellent, buddy. Very good. Well, welcome if you are joining us today. Welcome to the ScaleHQ podcast. We are live today, and we are live on Riverside as well as YouTube and LinkedIn, just getting amongst the technology and trying something new for us today. Welcome back to our regular listeners. Anyone joining us for the first time, we are obviously thrilled to have you. And if you are joining us live today, we cannot wait to engage with you and actually take your questions. My guest this week is Jackson. Actually, I never asked you, Jackson. Is it Millan or Millan?
You nailed it. First one.
Oh, Milan. Okay, well, it makes you sound fancier as well. Feels like we're in Italy together, aka the Wealth Mentor. Jackson, over the last decade, you and your business, I guess, have helped over more than 1,000 clients build in excess of $2 billion in combined wealth. That you've personally scaled multiple seven-figure businesses, and I know that your business helps founders create more profit, more time, and personal wealth by thinking differently about the way, although I guess the way I would capture it is the way they think about their business to ensure that it actually leads to the lifestyle that they built it for in the first place, and how to actually turn it into personal wealth. So today we're going to dive into some of the mechanics of your philosophies around creating personal wealth through your business. And so for our audience's benefit, they get to learn from your knowledge. And let's be honest, what business owner doesn't want to create wealth through their business? Am I right?
Exactly right, mate. I think that's what we all want. That's why we got into business in the first place, is for more freedom and flexibility. But there is often a big disconnect between the philosophy of doing that and the mechanics of how we actually implement structure and strategy to bridge that gap and get to financial freedom faster. So looking forward to unpacking it.
Well, it's interesting. I remember a lady called Tina Tower. I don't know if you've ever met Tina Tower. She's an online course, teaches people how to build online courses. And I remember her saying, you know, everybody used to tell me that everything was about mindset. So I spent all of this time on mindset. That was going to be the key to getting me to where I wanted to go. And then she realized, I met this guy who had a business that was doing $10 million in revenue, and he was a complete idiot. And he was such a just unenjoyable person to be around. And he just was not a nice guy, no one that you would sort of look up to, but his strategy was so solid. And she's like, and I realized after that it was actually about 60% strategy, 40% mindset, not 100% mindset or 90% mindset. She's like, you know, mindset's great, but without strategy, you've got a real issue. And I think that's what I really enjoyed about some of the things that I've seen you offer to your community, and some of the philosophies that I've seen you write in your books, is the practicality of it. You're teaching people strategy. And so, yes, I know you teach mindset as well, but primarily, how do we actually do this? How do we actually, what are the mechanics to get us through to building wealth? Now, for anyone who is joining us today, if you have got questions, you can feel free to load them into the chat inside Riverside, and we'll be able to see those questions coming through. And once we get about halfway through, if you'd like to join us live, we'll be able to accept your video calls and take your question live. But Jackson, if you could just kick us off with a bit of an overview of Aureus Financial. You know, who do you help? What do you do? How would you describe your typical clients?
Yes, so typically I started my career originally as a financial advisor at the ripe old age of 19. And I got involved in the space because my parents were business owners and they were very good at what they did, but they always sucked with money. Like, we always lived hand to mouth. There was never any money left over. I even remember at school, we were always one of those families who, when there'd be an excursion or a school camp, that we would have to go into a room and talk about payment plans. And I always had hand-me-down school uniforms and all of these things that were just kind of the telltale signs of Aussie battlers. And I got started in financial advice because I wanted to help people like my parents, because very early on I acknowledged the fact that my parents were working for money as opposed to money working for them, and they just didn't know any better. So I set out to kind of get that knowledge and be able to create a catalyst for change. But very early in my career, I actually became really disheartened. I was working for a business that was called the Financial Advice Centre, and it was almost like a scene out of the Wolf of Wall Street, Sean. Like, it was, aside from the midget throwing, it was like this bullpen of hundreds of representatives on the phone with this like toxic energy in the air of selling commission-based products to people like my parents who quite frankly didn't need them, and certainly wasn't going to help them create financial freedoms. So I became very disheartened and I almost quit. But in a fleeting thought, I said, well, if you're not going to do something about trying to fix this industry based on your interpretation of it, then who is? So I decided to start calling myself a wealth coach, and I built an educational-based syllabus designed on helping people like my parents get the foundations right when it comes to their wealth creation, and basically take their business profit and turn it into personal wealth. And that concept evolved over the course of a decade until up in 2017, we started Aureus. And Aureus has basically been built to help our business clients with three things. We pretty much exclusively work with 6 and 7 figure service businesses. So our clients are trades businesses, they're professional services, they're online businesses, they're medical professionals, fitness professionals, and essentially they know how to make money. They've got the economics of their business right. They've got clients, they've got leads that are coming in, they've got top line revenue, but their business is typically a cash eating monster. And we basically help them with essentially four things. One, we help them understand the economics of their financial model, and we help them create a business that is for profit. And essentially, as they grow and scale, that they can overcome what we call the scale tax. Two, we help them optimize their cash flow, because profit is one thing, but so many small business owners complain that they look at their financial statements and that doesn't match their bank account. So we help them implement cash flow structure that ensures they hold on to their hard earned. Three, we create a personal wealth strategy that shows them specifically how they take their business profits and then turn that into personal wealth. And we do that by ultimately trying to create a strategic plan that gets them to financial freedom in 10 years or less. And then four, we have a tax advisory and a strategic accounting business where we ensure our clients don't pay any bonuses to the tax man. They only pay their fair share, and that they're structured appropriately to protect their wealth for themselves and also the future inheritors of their wealth. And that's the basically cornerstones of our value proposition. And it's been a great journey so far, mate.
I love the idea of well, I don't love the idea of paying bonuses to the tax man. I've never thought of it in that way, though. I like the language. Jackson, people often wonder, when you're in your position or my position, has this guy actually, do they actually put this stuff to work in their own business? Like, can you tell people a little bit about the current stage and size of your own business?
Yes, so we've got a team of 35. We've currently, the business value is over 8 figures. We've done a number of significant acquisitions. We've also sold some businesses very profitably over the course of the last 6 years or so. And personally, I've been able to build over $3 million in personal net wealth by the age of 35. So we definitely practice what we preach. And it's interesting, I had a bit of a fierce debate with a fellow who was making some pretty kind of snide remarks on my TikTok over the last couple of days that was proclaiming that in order to be wealthy, you need to be born into wealth. And if anybody's getting into any indication of my kind of story, where I've come from, I didn't have a silver spoon in my mouth. My parents were battlers, their parents were battlers, their parents were battlers. I haven't been given any leg ups. And in fact, early in my career, after my father got really sick and I inherited the family mortgage along with all of the bills, I found myself in multi-six figures in bad debt and almost went bankrupt. So I've been in the pits of despair, and I've actually clawed my way out of it, and then worked my way to a position where I've been able to create a level of abundance and freedom. But I'm only just getting started, mate. So we're just kind of getting out of first gear.
I love that. I love that. And, from someone else who's been on the brink of bankruptcy, I think technically I was bankrupt. Well, I was technically bankrupt at the time. I didn't really know what bankrupt meant. So I remember thinking, well, I've got $20,000 on a credit card that's got no available limit. I've got $1,200 in the bank account, and I've got a $2,500 mortgage payment coming this week. If I don't make a sale this week, I don't actually know what happens when you go bankrupt, but I'm assuming someone's going to come and take me out of my house. And, I think until you've been to that brink, you don't really know how hard you can push, or you don't really know what sort of you're made of until you're actually really pushed up against it. So I feel you in terms of the learning and the strength and the conviction in your own capability that comes from actually being at the edge and coming back. Can we get stuck straight into principles, Jackson? I'm super interested as to you have a lot of strategies that you would teach business owners to achieve those three different outcomes. But if you were to sort of summarize the 5 most important principles that you think help 6 and 7 figure founders lead them to personal wealth through those businesses, what are the most important principles from your perspective?
Yeah, let me give you a little bit of I guess, a backstory on how the evolution of my principles have come about. So I'm neurodivergent, I have ADHD. And the significance of that is that many neurodivergent people suffer from being very emotional, being very reactive, and having these hyper fixations, whereby we fall into this rabbit hole of shiny objects and we completely rationalize that decision making, going all in, finding any possible excuse that validates that perspective that we may have, and then very quickly there's some sort of pattern interrupt that occurs, that we fall out of the rhythm, we completely forget about that thing, and then the kind of cycle rinses and repeats. And as I think back on it, like after I got my diagnosis and as I started to learn more about neurodivergency, I realized that my parents were the same. And it's very common for it to be a genetic thing, that neurodivergency gets passed along the lines. And I saw my father do this for his entire lifetime from from a very early age. That he was a big dreamer, and he had amazing ideas, amazing visionary, but he lacked follow through. And there was always an excuse. There was a bad business partnership, a bad economy, rising interest rates, bad luck. And for many years, I thought my old man was an unlucky man, but I've come to realize that he just lacked the level of intrinsic understanding of the principles that would drive him to create like measurable and sustainable long-term results. And through discovering this for myself, I've had to create principles and systems that protect me from myself, because I am my own worst enemy. And this is the same thing that we impart to our clients, because I think most people aren't in their driver's seat of life, business, and wealth. They become a passenger of their circumstance, and therefore they're at the mercy of luck and the external environment. So principles are by far the most important thing to run by. So essentially, I'll talk a little bit about the business. We went through an exercise many years ago, and I was fortunate enough to be mentored by a fellow by the name of Cameron Herold, who wrote a book called The Vivid Vision. And we implemented the Vivid Vision in our business, and we created a series of commandments. So we've got 10 commandments. And our commandments are that we build a business for freedom. We mindset multiplied by actions equals outcomes. 3, we focus on progress over perfection. 4, we lead with value and integrity. 5, we create a win for the clients, we create a win for the team, and we create a win for our business. 6, we fail forwards and we fail fast. 7, know your numbers, measure what matters. 8, always honor our word. 9, be good, do great, achieve more. And 10, live for today and plan for tomorrow. And within those 10 principles, it basically becomes our compass for every decision that we make, both personally and in the business. And it's been integral to our growth, our success, and navigating away from challenges and hardship.
Right. And so do you take those 10 commandments and teach them to your clients, or do you teach them different? Obviously, those have really worked for you and your partner. How does that translate to what you then teach your clients around how to build personal wealth?
Yeah, we've integrated this into everything that we do. So we share this with our clients and we discuss our principles, and that becomes the basis of our working relationship, that we must align with those principles at all times. They always must be in integrity with those. And if we're out of integrity, then we can't continue to work together. We also help them implement that into their own lives and their own businesses and their own wealth. And we also integrate this deeply with our team. When a team member comes on board, they get access to this vivid vision. They must review it as part of the process and share their interpretation and their takeout, so then we can measure once again, are we in congruence? Because I think if you're building a movement and you're trying to create something of significance, you must do it with a group of people who are all on the same page. And I think my job as the group CEO and as a visionary is to create that alignment at all levels. And the easiest way to do that is to understand the values that we share, because that's going to be the governing principles of how we make decisions and how we choose the path that we take. And the more closely aligned those principles and those values are, then the far easier it is for us to measure that we're always going to head in the same direction together.
So interesting. I love the fact that actually they're practical principles, but they're also values-driven principles. You know, some of them you can clearly see guide financial decisions. Some of them will, guide the way that you interact with your clients, the way that you interact with each other in the business. So it's actually a very holistic kind of a framework. One of the things I'm wondering is, one of the things that no one ever teaches you when you get into your own business is, well, there's a lot of things they don't teach you. And so, you end up figuring out a lot of things on your own or for yourself or through a mentor. But one of the things that I think is almost a black box is, and I can't think of any time I've actually really heard anybody talk about this, but I have seen it in your work, is if I've got a business that's working, let's say I've got a 7-figure business, I'm doing a couple of $1 million, the business is profitable, so I have money to spare. Now I could choose to take all of that out as dividends, I could choose to reinvest all of it, I could invest part and take some out. Like, how do you guide people how do you guide your clients to think about, do you have principles that underline how much of their profitability to reinvest, how they think about what they do if the business is working? What do they do with that? Because ultimately you're trying to build personal wealth. So I'm interested in that intersection between the business producing
Yes.
profitability and how do they use that personally and or back in the business? How do you think about that?
Yeah, it's really interesting, mate, because no one talks about this. And I think a lot of people who are in the business space, they focus exclusively on the business. That typically the philosophy is if you back the winning horse, you reinvest your profits, you double down. And on the flip side, people who specialize in wealth often silo the business that we're like, okay, well, we're only going to deal with the profits that you distribute. Like once you've paid yourself an income, then we'll deal with that surplus and then we'll invest that. And everything else that's the business's money is going to be ignored. And I'm like, wow, this thinking's backwards. Like, because from my perspective, there's three ways to build wealth in this world predictably. There's business, you build a profitable, viable business, you create leverage so you can disconnect your effort from your income and reduce key person risk, and you position that business for sale so you can hopefully achieve some sort of liquidity event at some point in the future. And if you're interested, do acquisitions, which we'll talk a little bit about. Now, secondly, property. We buy good quality blue chip property in desirable locations where affluent people want to live, and there is a scarcity of future supply. That the supply and demand economics of that is going to mean that property will typically always appreciate in value. And better yet, we can use the bank's money to magnify our cash on cash return. So, and then thirdly, we invest in the stock market because property and business is illiquid, and we want to make sure that we've got liquidity so we can access to cash, and because so many people end up being asset rich and cash poor. But we also don't want to necessarily throw darts at a dartboard in stock picking. There's multiple ways, and my own personal philosophy is index-based investing and exchange-traded funds. A bet on markets as opposed to companies, so I can set and forget my portfolio and not have to worry about it. Now, probably more importantly to that is we don't want to mistake wealth creation vehicles for destinations or outcomes. We must firstly define what financial freedom means as an individual, okay? And usually we take our clients through an exercise that's called the 20-year roadmap. We take them through documenting all of their lifestyle and financial goals over 1, 5, 10, 15, and 20 years. And we quantify each of those into time and money. And what that enables us to do is to reverse engineer that into how much surplus must be allocated each and every single year in order to fulfill all of those lifestyle and financial goals. And then based on the cost of your lifestyle, we can now set an income target that allows you to essentially have your cake and eat it too. That you can live a great lifestyle without sacrifice and compromise and achieve all of these goals. And most people don't have an income target. They just pull the number out of the air, right? Like I want to earn 100 grand or 500 grand or a million, right? No, we can connect the outcomes to the real number. And then that's just a process of reverse engineering. So philosophically, what we try and aim to do is firstly, I believe that a business should be able to allow the founder to create financial freedom without the business having to be sold. So what we do is we set a profit target that allows the founder to earn that income, to have the surplus to achieve the 20-year roadmap. And then once again, it's just a reverse engineering. To earn that profit, we've got to have a certain amount of revenue. To earn that revenue, we've got to have a certain number of clients. We've got to charge a certain amount of money. We've got to have a certain amount of leads. So once again, activity to outcome, connected. Then what we aim to do is once we've got those foundations in place that we're actually systematically taking business profit and turning that into personal wealth, we now do a risk-rated return analysis. So we need to understand that in the world, when it comes to building wealth or manufacturing assets, there is always going to be a relationship between risk versus return. And ultimately what we want to consider is, well, keeping money in cash is the safest possible thing that we could essentially do. And punting on, say, cryptocurrency or speculative investments might be the riskiest thing to do. And obviously our business and property and shares are on a spectrum beyond there. If we're going to be capital allocators, we must have a mechanism or a methodology that supports that capital allocation. So for example, in my own business, I aim to produce a 30% compound annual growth rate per year or more. I aim to maintain a 30% EBITDA margin. I aim to keep 3 times cash to expenses. And I aim to set my business up so I have 100% recurring revenue to expenses from existing clients. And if I achieve those operating rules, all of my surplus profit, above and beyond what I've already taken out to fuel my personal wealth plan, should be reinvested back in the business, because where else am I able to predictably get those kinds of returns? But if I ever get to a point in my business where I can't do that, Let's say my business is only producing a 5% compound annual growth rate at a 15% profit margin. Well, maybe it makes sense for me to take that out and start putting that into more property or more shares, right? It's all about understanding the risk-rated return of that. And this is where we start becoming pragmatic asset allocators as opposed to throwing darts at a dartboard or guessing or being emotional around our capital allocation. And that's the biggest issue for most people.
Oh, I love that. And one of the reasons I love it is if any founder has never tried to reverse engineer that plan, which I expect many have not, you'll probably find you're doing the same thing in your business, even in your sales team. Okay, have you actually even reverse engineered the sales target for the individual, to your point, from the revenue they need to achieve to the number of appointments, the number of proposals, the number of appointments, the win rate, the lead rate, all the conversion rates, all the way. How can you expect a salesperson to focus on the right activities if they don't actually know what the success ingredients look like? And what that allows you to do, the best thing about that, of reverse engineering that plan, is that it allows you to feel successful when you're just doing the activities, even if you don't have the outcome yet. And so I imagine the same emotional feeling is what you get when you've worked through, you've sort of reverse engineered your financial plan. And I mean, if I've the number of spreadsheets and things that I have reverse engineering my next 20 or 30 years is pretty insane. So I'm with you on it, and I think about it a lot, because to me, I want to know. Sometimes it's like watching the grass grow, and you don't want to find yourself getting frustrated because you know any of the outcome yet, or feeling like it's so far away. Actually, when you can focus on the activities, you can feel successful all the time, because you know that it's actually now just a time factor. And to your point, the liquidity event, one of the things that I work with all founders on is to say, to me, it doesn't actually matter what your goal is as to whether you want to sell, whether you want to be able to step back and install management, or whether you want to continue to scale up. Like, my goal is to help the client achieve their vision and their personal ambition. However, we always build to sell. Always build to sell from day one. Always thinking about, is this going to have the ingredients of a business that, and when I say build to sell, that may be to sell to somebody externally, or it may be to sell down to management. So I've got some clients right now that are in an active process of, they've brought on a general manager or two capable sort of, directors in their business, and they are in the process of slowly selling down their equity to management over time. So they're capturing some of the upside as the business grows, but they're also creating some little capital liquidity events, but they're also hanging on to the golden goose because it's still laying eggs, but it's probably not the easiest business for them to sell to an external party. Or maybe they can, but the multiple they're likely to get is insufficient, or is almost nonsensical. It's like, why would I sell this business for 3 times? And if I'm growing at 30%, I'm going to have that money in 2.5, in 2 years. So why sell it? Yes. Maybe I can hang on to it for longer. And so I think some people get hooked up in the idea that there has to be a sacrifice forever, just channel all the money into the business, hope in some way that it's going to become something amazing that somebody wants to buy, and then have a giant liquidity event. In between now and then, we pretty much got to live on baked beans and just invest 100% of the dividends back into the business. And I 100% agree with you. That is putting a lot of eggs into one basket, and the benefit of that really simple and clear diversity pays dividends over time, because you can't predict the future, but that you've got hedges now. You've got leverages, and you've got opportunities in different baskets in which to create that personal wealth.
Exactly right, mate. And look, the thing that I've come to realize is that as a business grows and scales, they encounter that scale tax that I mentioned before, that the business becomes a cash-eating monster, that without the right structure and without systematically taking chips off the table, the business will consume the excess without you even knowing it. And in many cases for our clients, like when they come to us, and the biggest barrier to them reaching out to us in the first place is that they have this preconceived idea that they've been a business owner, they've eaten the no-name cat food for dinner for a period of time, they've gone through the sacrifice, they've turned the corner, and now they're playing a little bit of lifestyle catch-up, because it's been the first time in a long time where they've been able to kind of take some chips off the table, and usually it's to compensate for lifestyle, upgrade the cars, upgrade the family home, go on nicer holidays, upgrade the wardrobe, that kind of thing. And they feel like if they're going to start building wealth, they're going to need to compromise and sacrifice that. And in the vast majority of cases, that isn't true. For many of our clients, just implementing our financial operating system will skim 15 to 20% off the top without a meaningful change to their lifestyle or the way that they spend money. because what this comes down to is behavioral science, Parkinson's law. Our business, particularly once we get to seven figures and beyond, is the most financial means that we've ever had our hands on as a human being. And often that becomes easy come, easy go. That money comes into the business, often into a single bank account, and we call it the single account sinkhole. And then before they know it, all of the money's gone, and they've got no idea where it's gone. And when we implement this structure, as a result of overcoming that Parkinson's law, that we're able to make some arbitrage opportunities where with that extra amount that we skim off the top, we can use that for wealth creation and you don't even feel it.
Can you give us an example, Jackson, just to help, what are the principles of that financial operating system? How to give us an example of how the money flows
I'll give you an
through.
example. So we had a client that come to us a couple of years ago who had a really great plumbing business. And he'd been in business for a really long time, multi-seven-figure business, absolutely crushing it, had sustainable profits, had seen kind of competition come and go, and he was by far the market leader. And then due to some economic changes, obviously post-COVID, the cost of material, cost of labour fundamentally changed. And he went from having a really profitable business to having his first ever loss in his business. It was almost a $100,000 loss. And he's just scratching his head as to why, because he's working his ass off, thought he was doing all of the right things, had made a couple of not perfect hires, and all of these things kind of capitulated into this loss-making business. So essentially what we did is a few things. The first thing we implemented was a financial performance dashboard. We helped him understand the financial model of his business, because essentially what had happened is that he'd outgrown his previous financial model. And as a result, it had come at the cost of his profits and then come out of his pocket. We then helped him understand what his financial freedom plans were. At a relatively modest amount, but we need to work out exactly how much he needed in order to be financially free and the time frame to get there. We then implemented a cash flow structure that we call a profit mastery machine, which is a series of about 5 bank accounts, all with a really specific purpose. So we segment cost of sales from operating expenses, from owner's pay, from tax, from profit, and we have certain rules that govern how money gets swept between those bank accounts, allowing us to essentially put his cash flow on a diet. So we end up counting the calories, and as a result of that conscious counting, that we curb the caloric intake or the consumption of that cash flow. And then thirdly, we helped him understand his cash conversion cycle. So one of the biggest issues for his particular business was that he didn't understand exactly what his cost to serve was and how much he needed to collect through the various stages of these commercial projects in order to ensure that he was cash flow positive the whole way through. And what ultimately happened is as he was growing and scaling his business, his bank account was depleting and he had absolutely no idea as to why, because he just didn't understand the basic economics of his financial model. So through that level of education, we were able to flip it around. So in about 18 months, we took his business from about $100,000 loss to a $250,000 per year profit. So it was a pretty significant turnaround. And now we're working on what have we got to do to position that business for sale and work towards being financially free and then building wealth for retirement.
It's really interesting. If I think back to some of the conversations that I've had, and sometimes it's a tough conversation around the level of profitability of the business model in general. Like I imagine you see some clients that come in and they've got 5 to 10% EBITDA, and you see some clients that come in and they've got 30% plus EBITDA. And I don't know what your experience is, but certainly my experience is those with 30% plus EBITDA are always pretty relaxed. They've got a lot of options. Their cash builds well. They've got plenty of choices. They can usually afford to hire good people. They can take hits. They can usually deal with some headwinds from time to time. And then I have other clients that I've worked with who've had 10% or less in EBITDA, and no matter what the revenue, whether it's 3 mil, 6 mil, 10 mil, 15, 20, 30, it's a stressful experience. Because there just is not a lot of headroom, and that's sometimes a really deep reflective point to go. It's not usually am I in the right business. It's have I got this business model sort of set up in the right way to achieve an appropriate amount of earnings. What do you do when you find a client at that sort of stage? How do you help them think about how to get the profitability sorted?
There's really 2 realms of thought here. One, my initial process is always challenge the status quo. I'm a believer that there should not be a business, particularly when we're dealing in small business land, of any business that's less than kind of $30 million in turnover, that doesn't have the opportunity to do a 20% or more EBITDA. It just comes down to the engineering of the financial model. I'm talking service businesses here. I understand that product businesses are a different beast. So when we're talking about a service business, you should be able to do a 20% or more EBITDA. The way I look at it is 10% is an average business, 20% is a good business, and a 30% or more is a phenomenal business. So we either need to work out, well, what are the unit economics and the re-engineering of that business model? And I break it down into kind of three things. What's the positioning that needs to occur in that particular business in order to justify an increase in price, right? And if you're a commodity, you're always going to be at the mercy of the market pricing. If you're a utility, you're going to be at the mercy of the problems that you solve and the value that problem represents. Or if you're a luxury, it's about how do you make your clients feel as a result of working with you and the outcomes that they realize as a result of your service. Because we all exist on that spectrum. The second part is pricing and packaging. How are we pricing for profit? And most commonly in service businesses is that people are pricing based on like this guesstimate, right? They've had this kind of pricing philosophy that they've guesstimated their way through it. And they're like, yeah, this seems okay. This seems right. And they've never done an audit, a cost study of being able to actually back cost everything, audit particular jobs from start to finish, see where the cash flow bottlenecks are in that project, and then work out a better pricing model. Second, how are they actually packaging it together? Because the reality is in the marketplace that if somebody's going to go out and buy an apple or a kilo of apples, it's very easy for them to make a direct comparison of 1 kilo of apples to somebody else's kilo of apples. However, there's certain people in the marketplace who will pay a premium for freshly squeezed cold pressed apple juice, right? So if you can just package things better, then there's opportunities for you to price in more margin. And then the third part is about the cash flow, of understanding how do we create consistency of cash flow, which is all about understanding how money transfers from the P&L to the balance sheet and obviously into the bank account. And we need to be able to track inflows and outflows through every single stage of the cash conversion cycle, ideally front-loading cash. I want businesses to be able to get paid before they do any piece of work or lift a finger. As opposed to some clients that I've had, Sean, I had a particular client that I worked with for many years, and they came to us on the verge of going broke. They were a very big agency working with global FMCGs, and they had 90-day end-of-month payment terms. It was ludicrous. And these were like multi-six-figure projects. And they built a really stellar reputation, winning big contracts, and they were growing like crazy. But when they came to me, they were on the verge of insolvency because I said, look, for every project that you take on, you need this amount in working capital in order to subsidize your fixed costs of that project until such a time as you get paid. We just don't have enough working capital here. And the faster you grow, the faster you're going broke. So most business owners just don't have this level of financial acumen because they're not at a level where they can hire a CFO. And certainly most accountants aren't having these conversations. So that's the kind of role that we play.
Yeah, it's such an interesting challenge when I think people can really normalize rather than, what's the right way to language it? I think you grow up in an environment, in an industry, and most of the founders that I work with, they've grown up as a technician in some kind of industry. They get to know it well. They think they can do it better themselves. Usually they can. They start a business. The business starts going well, and they're like, oh shit, I've got a business, and I need to figure out how to turn this thing into a company. Great. However, they've normalized everybody else's stuff along the way. Like, this is just how the industry works. Everybody prices like this. This is how many people consider is an appropriate, accounts receivable days. This is how often it should take. This is how quickly you should pay your contractors. Like all that stuff. And quite often, as you would know, lots of those situations are not something that we just have to accept. Actually, you can design all sorts of things in a way that suits you. But I think to your point, I really like the intersection between positioning, pricing, and the cash flow model, because the more differentiated you are able to make yourself, whether there are in the way that you package your services and the additional things you might offer, some of those might be really high perceived value, but not actually cost a lot, like high perceived value from the client's perspective. The more you can separate, I guess it's a bit sort of, blue ocean, the more you can separate yourself from the pack and end up with fewer people that you could even say are a competitor to you, the greater your capacity to say, hey, we just do things differently here. Like, this is what everybody else does. Like, almost imagine putting your business in 2 columns on a piece of paper. Here's the normal, here's the typical, here's what everybody else does, and here's what we do. And even going through that thinking exercise helps you to start to separate yourself from the kind of the wheat from the chaff. And then it's like, hey, well, yeah, I know that everybody else does, 90-day end of month payment terms because you're a big company, but actually we get paid in advance and we don't work until we do.
Yes.
So, feel free to work with us or don't, I don't really mind, but you're not going to, you allow yourself to attach it. I've bought businesses, or haven't actually ended up making those transactions usually, but have looked at the financials of many businesses for acquisition and gone, hang on a second, your accounts receivable days are more than 30, but your accounts payable days are like 14. So you're paying everybody at twice the speed that you're getting paid. That's a problem.
Yes.
But
Exactly.
it feels like that's a little bit backwards, don't you think? Don't you want to get paid faster than the money's going out? And it's such, when nobody teaches you this stuff when you're growing up, you just don't know when you're growing up as a founder. Like
No.
you can't know what you don't know. But this stuff actually really makes a huge difference, because the founder that's going to be feeling very comfortable is the one that's got the majority of the cash in that bank account. And every time they take on more work, the cash balance increases, not decreases.
Exactly, mate. And look, I'm not a marketer, right? But there is an intersection between economics and marketing in business. And I've kind of stumbled across having to have these conversations and create these frameworks for clients, because I think for so many businesses, you hit the nail on the head, right? They go from technician and then they start to create some scale and they kind of fall forwards into all of these various roles and kind of fumble their way through it and learn it as they go. But at the core of everything, that we must understand the economics of our model of what are we creating that is going to provide us with the surplus financial means to be able to have the freedom and flexibility that we got into business for in the first place. And once again, we can reverse engineer that to say, okay, well, this is exactly how much volume I've got to do, how I need to price myself to make this much revenue based on my cost structure to make this much profit. And then it just becomes a matter of, well, how do we then solve for that problem? If I need to increase my price by 20%, how would I need to change my process, the way that I engage my clients and customers, the way that I position my value, the way that I articulate my point of difference, that I reduce friction, that I increase social proof in order to get more yeses than nos? And it just becomes, it allows us to identify the next problem to be solved. And the way that I try and position this, Sean, is that all of us in business, we're like a crane operator. We're sitting in the crane tower and we've got all of these levers in front of us that we can pull. And for the vast majority of business owners, they haven't gone to crane driving school, right? And they're just pulling levers willy-nilly and waiting to see what happens, right? It's a very lackluster kind of trial and error approach. But when you understand, and let's say that you now have the education to label all of the levers, and each of those levers have a sensitivity percentage. That, hey, if I pull this lever, it's super responsive. And if I pull this one, it's not very responsive. It now allows us to then make the right decisions of the things that are really going to move the needle forwards. And that must come from a level of financial comprehension and understanding, because numbers don't lie.
Yeah. Oh, so interesting. And really enjoying this conversation, Jackson. One of the things that you mentioned earlier, and I know that is part of your business overall strategy, is acquisitions. Now, acquisitions, having done quite a number of them and looked at, many hundreds of businesses for purchase on the investor side, it's not necessarily for the faint-hearted, but it's an incredible way to build. It's an incredible way to build wealth, number one, and I think a massively underrated vehicle for people who've got the appetite and probably the leadership capability, depending on what the strategy actually looks like. But it is an incredible way to build wealth. But I was wondering whether you could talk to us, and maybe we can back and forth a little bit on why is it an incredible way to build wealth? Like what is it that makes acquisitions an interesting way to build wealth in as a group of companies, or as a sort of consolidated, integrated group of single business that's consuming more teams or more customers? Talk to me about how you're thinking about it and why you've chosen that as one of your vehicles.
Yeah, I've learnt a lot about this over the years. I was probably very naive. Interestingly enough, when we started our first business plan, we're like, yeah, we're just going to go out and buy all of these businesses, and in 3 years we'll build $100 million business, and we'll be off to the races, and Bob's your uncle. It didn't necessarily work out that way, and we've kind of iterated the philosophy over time. So first and foremost, the idea of building a business is that you either build it organically, and that requires you, in order to kind of nail that positioning, to make sure that you've got product market fit, and to be able to leverage marketing strategies and tactics in order to acquire customers, either through traditional organic content and referral partnerships and all of these kinds of time-based strategies, or money-based strategies through paid ads and paid digital marketing. And that's one way. And it can be very, very profitable. However, it requires you to front the cash and the time up front. And usually it's going to be a slower burn because obviously it's like a snowball that kind of compounds over time. The alternative strategy is acquisition, that you essentially go and buy the efforts of somebody else before you that's already built it to a certain level, and you will pay a premium for the privilege. So to give you some context right now, in our own business, we have, in our digital marketing efforts, we get about a 6 times return on investment. So it's about a 600% return. For every dollar we spend, we get $6 out.
And $6 out on an acquisition. $6 in revenue. So a dollar spent on customer acquisition returns $6 in revenue. 6 times
exactly.
ROAS.
And our quantification of that
that's
is
what
our
people mean by ROAS.
Exactly, our return on ad spend. And that $6 is basically the contract value over 12 months. So we don't use real lifetime value, it's 12-month value, if that makes sense.
Yeah.
Now, on the flip side, when we go and do an acquisition, we typically buy a business on average between kind of 2 and 3 times EBITDA. Typically, if it's a really good business, up to 5 times EBITDA. So if we break that down, we're getting between kind of like a 15 and a 33% return on investment. So the economics of that compared to our paid advertising is very, very different. But what we get is we get scale. We can go and acquire, say, $500,000 or $1 million of EBITDA, and with that acquire, say, $3 to $5 million of revenue, and that allows us to then create a bigger snowball that continues to roll. So our strategy is what we utilize what we call the Ansoff matrix. So for those who aren't familiar, the Ansoff matrix is basically an acquisition matrix of understanding that there are markets and there are products. So the first quadrant that we look at is what's called the market penetration strategy, where we look for where we have existing products and services in existing markets. And essentially we're buying businesses in order to create economy of scale. The next part of the Ansoff matrix is essentially new products in existing markets. So this is our next part of our strategy, where we're looking for other B2B service businesses that we don't already have, that we can bring into the group and allow us to capture share of wallet, things that our clients are already spending on or prepared to spend on. Because my philosophy on this, Sean, is that the more that a client spends with us, the more I can afford to acquire a customer, meaning that I can outspend my competition on acquisition.
And so for an example, if you've got an accounting business and those same clients also spend money on legal services, on digital marketing, on a whole range of other things, like what are their expense lines in their business after you get past their wages? You can almost go from top down, work through their biggest expenses down to the smallest and go, does that make sense as a tangential business for us to get in? That's your new products into existing markets.
Bang on, exactly. And look, we've estimated that for $1 million business, they typically spend 20 to 30% of their top line on professional services, digital marketing, and other growth vehicles that are going to allow them to achieve their business goals. So if we can capture even a fraction of that and be able to deliver value above and beyond what they're already getting, then it's an absolute no-brainer for them. And then the third component is basically existing products in new markets. So this is about getting access to territory. Because we are professional services and business owners still operate belly to belly, it's about then buying businesses that are in different geographical locations. We're primarily focusing on Australia to be able to give us that territory, which also gives us access to those new markets. And then the last quadrant is diversification, where it's new products in new markets. We're not focused on that. That's where I invest in property and shares, because I feel like I have control over those other 3 quadrants. And that's what I refer to as strategic acquisitions, because there is a strategic value of those businesses being added into the group. Yeah. And then from an economic standpoint is that essentially our strategy, because we've got a diversified group, let's say we're valued at between 7 and 10 times EBITDA, because we do have a multidisciplinary, multi-share of wallet practice, that we can go and buy a business, let's say at 3 times or even 5 times. And we get this immediate accretion of value or an arbitrage as a result of bringing that business into the group. So for example, let's say we buy something for 3 million at 5 times EBITDA, we bring it in at 10 times, that business is automatically worth 6 million. So we've been able to kind of get, although it's a kind of an ego factor initially, but it's a way that we can essentially continue to snowball the accretion of value in the group and essentially rinse and repeat that process.
And that, that in and of itself is one of the reasons that I just think acquisitions is so interesting. I know you and I were having a conversation in the last couple of weeks about what most people do when they think about acquisitions is they immediately mentally calculate. So, okay, sort of return number one is the arbitrage between what you can buy it at and what it's immediately worth. And so I liken that to, you know, making money on the way in when you buy property. It's like, well, you need to buy right up front because actually you want to make money on day one and then have the ability to, you know, accrue and create more value as step two, but you actually need to buy well on step one, and that's where you get the majority of your value from. And what most people do is think, well, it doesn't really matter what I buy it for because I'm going to have all of these top line revenue synergies. I've got these customers, they've got those customers. I'm going to sell my stuff to their customers. They're going to sell my stuff to their. I'm going to sell, well, the opposite of that. Got tongue tied there, but you know what I mean. It's like we're just going to cross sell all of our stuff to those customers, and the business is going to double in size, and it's going to happen in 5 seconds. And that I can tell you from lots of experience is so much harder to do than you think, because it comes down to the really small things like, okay, but how do you incentivize their sales team to even give you the time? You've got to teach them about your product. They've got to introduce, what about the brand? How does that customer feel about this new brand that's got this new service? Is it now the same brand? How do you literally make the introduction to get the sale? And it's just a lot harder than you think. So I always think,
Yeah, 100%.
the biggest money gets made on the arbitrage by buying well. And then if you can create some top line synergies, great. But actually, let's go and call that Horizon 3. Horizon 2 is, are there any bottom line synergies? Are there any costs that we are duplicating in these businesses where it's not about going into a business and stripping all of the hard out of it? Because actually that's a great way to destroy value very quickly. Like if you think about the way you acquire, you need to actually integrate. You are buying access to a group of people whose collective minds are creating value somewhere. So if you go in and be all sort of top heavy, cut half of that out because you just think there's some duplication and do it really poorly, you'll reduce a lot of value in that business. However, to your earlier point about the arbitrage, if I bought a business at 3 times, but as it comes into my group, it's now worth 7 times. And then I have even one duplicate roll of $100,000. That's not $100,000 I've just made or saved. That's actually $700,000 of value I've just created because it's the $100,000 times the multiple. So it's like Horizon 1,
Yes.
get the cost right as you buy. Horizon 2, look at cost synergies. Horizon 3, look at revenue synergies. And if you think about it in that order, it's an unbelievable way to create value. I'm interested though, Jackson, when you are
The hard
buying.
way, mate.
Yeah, it's not for the faint-hearted, is it? But you know, the great thing is
No,
there are people around who've done it before, and if you can find some people in your network that have done acquisitions before, they can help you reduce a lot of the mistakes that are inevitable in first-timers, and it is possible to do it. And once you've done it once, you'll learn so much about how to do it the second time, the third time, and the fourth time. So I usually think about it as, to your point, as a strategy, not a one-off. Like buying one is okay, but if you think about it actually as a strategy where you're going to be doing this multiple times, you will get better and better at it. So rather than like renovating a business, a bathroom once and probably doing a pretty average job, by the time you've done your third one, you'll be pretty good at it. Jackson, how have you, so let's just say business owners listening today go, that's a great idea, always wanted to do an acquisition, sounds amazing, think I'd do a great job. Can you talk me through how you finance those?
Yes. So I think, well, first and foremost, I probably want to preface by saying, you don't want to get into acquisitions until your business is in a position where it can essentially run without you. You should have a management structure in place. At a very bare minimum, you should have a GM or a chief operating officer, divisional heads, that the business can run itself essentially with your advisory, because the worst possible thing that you could do is to split your focus down the middle between 2 businesses, and usually one's going to be doing well while the other one's doing crap, and it's just going to be this teeter-totter where you want both of them growing the same way. So I see people get excited about this and end up doing more harm than good initially. So I think that's first and foremost. In terms of capital structure, we typically do a mixture of cash and essentially commercial debt. So usually in most of these acquisitions, most lenders or business lenders who operate in this small business space would prefer residential security. Australian banks are very, very conservative. And if you've got a title of a house that you can give them, they don't care what you go and use the money for, frankly. But borrowing against businesses, unlike in the US and other parts of the world where there's really great business lending schemes that are in place, we don't necessarily have that in Australia. Australia. So there are a handful of specialist lenders that operate in the business space, but usually that's going to happen at a much lower loan to value ratio than most of us would like. Typically it's 50%. Depending on the type of business, it potentially goes up to 70%, and it's usually going to be amortized over a kind of a 7 to 10 year term. So the repayments can be pretty thick. So the important part is about being able to understand your amortization calculations and understanding not just the interest repayment, but your principal repayments, and ensuring that the business can essentially underwrite its own expense of capital. And that's something we really focus on, which also means it's one of the reasons why we target businesses that have 30% more profit, because otherwise, if they've got anything less than that, they're really going to struggle to have working capital to fund the debt and have extra to be able to reinvest back into integration and growth. So we've got lending in-house. We're very fortunate. We've got some great lending specialists, and also you've introduced me to some heavy hitters at the top end of town, mate. So I'm starting to get educated on kind of the next stage of lending as we go to that pathway to 100 million. There's a lot to learn.
There is a lot to learn. One of the things I would say also is that when you think about businesses that, and I think, you've probably had success perhaps in some of the first acquisitions in doing some of the smaller businesses, but one of the things that I learned over time was that it takes exactly the same amount of time to do the due diligence, to do the integration, to communicate properly, to do all the things necessary to succeed. It takes exactly the same amount of time in a $1 to $5 million business as it does in a sub $1 million business in terms of EBITDA. But the big difference is there's usually a lot less risk in the larger business than in the smaller one, because ultimately, if it's a sub $1 million business, it's probably founder-led. And so, there may be some vendor sort of cliff type risk, like, the vendor's just got some money and now they're a bit disconnected if they're staying as part of the group. They've kind of got one foot out of the door, or, you've got a lot of the energy of the business tied up in a person, as opposed to a larger business where they also have a good quality management team, and actually the leader is slightly less important. If that leader was, all of a sudden not acting in the way that you hoped or whatever, you could replace that leader and actually the business will carry on. So, that doesn't mean that you jump straight into the water and start with a business, doing $2 million EBITDA as your first acquisition, probably not. But it is interesting over time. That's why I also encourage people to think of it as a strategy, because actually you'll find it's far more fun when you buy the bigger ones, because you realize actually there's a lot bigger bang for buck. They have a lot lower risk profile usually than the really small ones.
I agree. And I think often in many cases, the smaller businesses can be hard at work because those clients have had a deep relationship with the founder. They're almost auditioning you as the incoming acquirer as to, well, why should we continue to work with you? As opposed to when it is a bigger business, it's already a corporate entity. They've had multiple relationships. It's not that big of a deal. There's still certain optics that you've got to maintain, but also there's just not the operational infrastructure, and they haven't necessarily proven their ability to scale yet, right? A lot of it, those sub-$1 million businesses, is a bit of a pirate ship as opposed to buying the Navy. So I agree with you wholeheartedly. And we're kind of in that territory where we've done some smaller acquisitions, but we're now starting to get into that kind of multi-seven-figure territory. So we have the opportunity to acquire things that are a little bit easier to integrate and then give us more upside opportunity because of the economy of scale we create.
I know we've spent a little bit of time on that, folks, but I think it's not a conversation that you usually get access to in the world of small business. And so sometimes it doesn't, until it's actually on your radar, it's not on your radar. And so I think it's a good time if you've got a seven-figure business to get it on your radar. I think, as Jackson said very aptly, you want to ensure that your business has already got a management team and is pretty well structured and operates quite well without you before you entertain it. But it's something to consider as a work towards for your business. Jackson, in wrapping up today, what would you hope that founders go away in action from this podcast, from listening to you today?
I think the most important thing is just recognize that your business is a vehicle. It's not the destination. And because it is all consuming, it's very easy to fall into that kind of pattern where it consumes all of your thought, all of your energy. And we must reposition it as a vehicle for creating wealth. So the thing you need to walk away and do is you need to get clear on your financial freedom figure. And I've got a whole stack of resources that I'll share with you so you can actually define that and create the 20-year roadmap. Because once we've got that, we can start reverse engineering that backwards and work out if you're actually on the right track. Is your business at a certain amount of scale? Does it have the margins? Are you on the right path to be able to presuppose your ability to create financial freedom? Because the worst possible outcome here is that you've created this business, you've incurred all of this risk, you've got all of this uncertainty, and you're not on track for financial freedom. Like, what's the point? And if you have to rely on selling your business in order to be financially free, you will always be walking on eggshells, as opposed to having the ability to create financial freedom. And then if you do sell your business, it's just cream on top, and it allows you to elevate the quality of your lifestyle. I think the next part is you need to have the right people in your corner. We're not taught this stuff at school. I've got my master's, and frankly, I didn't learn this stuff even at university. This has been through having mentors like yourself, Sean, about working with people who have been there and done that, of reading very specialist books, going to specialist programs. I've spent probably close to 7 figures on personal and professional development. So you need to have the right people in your corner who can shortcut your path to the answers, so you don't need to pay the dumb tax, because other people have already paid it multiple times over, so they can impart that wisdom upon you. And you need to be prepared to take action on this, right? Like, a good idea in theory remains exactly that, just a good idea until you put it into practice. And most people just defer wealth creation because they're like, oh, that's for me when I'm old and grey. But you need to start now, because the sooner you start, the less painful it's going to be. So I'll leave you with some resources. If you want to get access to my 4 international best-selling books, and if you also want to get access to our 40-point financial performance scorecard, which will give you guys basically a comprehensive report that'll tell you exactly where you should be focusing your attention, and also a whole heap of other goodies, go to wealthhealthcheck.com.au. That's wealthhealthcheck.com.au. You'll get all those resources for free. You'll complete the scorecard. You'll get your customized report, and at least then it'll give you some clarity around your next best moves.
Fantastic. Jackson Millan, I have absolutely enjoyed the conversation today. Thank you so much for your generosity of time and spirit. And folks, if you've been listening to today, I strongly encourage you to act quickly to start to reverse engineer that wealth plan, because nothing is going to give you a greater sense of comfort as to whether, to Jackson's point, you're on track or off track. And if then you need some help, you can reach out to Jackson, you can reach out to myself, but fundamentally find the right mentor for you to help you get started on focusing on the priorities to get them in the right order and get you to where you want to go. Jackson, thank you so much, and we look forward to chatting to you again soon.
My pleasure, mate.
Thank you very much.